Chapter 5. The AVWAP pinch. Stocks that move out of a pinch can offer some of the lowest risk, highest probability trend continuation trades. Learn to recognize how this AVWAP strategy forms and how to trade it effectively for larger profits. Markets are not one-dimensional, there are trends within trends. When a longer-term trend begins to pull back, it forms a short-term downtrend within the longer-term uptrend. An AVWAP pinch refers to a compression of energy from buyers and sellers for a stock or broad-based market as the range tightens between two different AVWAPs. The original AVWAP acts as support or resistance from the longer-term, more powerful trend. The newer AVWAP contains price action from the counter-trend corrective move within the larger time frame. Look for high-probability trades when the shorter-term trend comes into alignment with the longer time frame trend. The emergence of an AVWAP pinch is often the start of that alignment. Market movement occurs with a price and volume, expansion and contraction, often alternating. The AVWAP pinch forms when the battle for control creates a compression of energy, represented by a tighter trade range. Eventually the range breaks and the buyers or sellers take control of the trend to create a new momentum campaign. While the stock is in the pinch, it is just a setup, not a reason to buy or sell. We should not take action until it breaks out of the consolidation area by making a higher high, long, or a lower low, short. Chart 5.1 shows how the pinch forms between a longer and shorter term AVWAP. In Chart 5.1, we recognize the anchor, 1, as a significant low only after the stock has built momentum from that level. 2. As the stock progressed higher, it didn't break to a lower low until 4. At that point, we know to set an anchor to the highest high. 3. Then the stock began to pinch, that is staying at a price between the AVWAP starting 1 and the AVWAP starting 3. When the stock breaks out of the pinch 6, it can be purchased with a stop below the most recent and relevant higher low, near 5. How the pinch forms while the stock is in a pinch. It is a battle between buyers and sellers. As the range narrows, it shows a constriction of energy, and the stock comes closer to a state of equilibrium. The dynamic support and resistance ranges formed by the converging AVWAPs show the interplay of the larger timeframe trend and the shorter-term counter-trend movement correction. Think of the pinch like squeezing a spring together. The energy gets compressed until the spring is let go and an energetic move follows. Trading volume and price range tend to contract simultaneously during a counter-trend move, i.e., a pullback in an uptrend or short-lived rally in a primary downtrend. This action shows a lack of near-term certainty by buyers and sellers. There is no advantage to be involved in the stock as this battle continues and the stock is in the pinch. Instead, we want to watch the stock for the reemergence of the primary trend so we can participate as the short-term trend comes into alignment with the longer, more powerful trend. While the stock is in the narrow range of a pinch, we want to prepare our trade and think through the scenarios of how the trade might work out. This process is where we develop our risk-reward scenarios. We set alerts on our trade software, so we know the moment price begins to move. Large moves often emerge from a pinch as many participants are not alert to the quick price changes, so they end up chasing the momentum. As we discussed in Part 1, Chapter 2, stocks alternate between periods of price range compression and price range expansion. We want to identify where the range compresses, prior to the next momentum campaign, so that we can anticipate the breakout of that range. When we buy the stock as close as we can to the emergence of a new trend, we maximize gains and minimize our risk. When trends come into alignment, they present us with low-risk, high-probability trades. How we participate as a stock breaks from a pinch is illustrated, along with the appropriate stop placement, in Chart 5.2. The stock in Chart 5.2 experienced a strong run from 1 and began to pull back 3, so we set a new AVWAP in red back 2. The stock then pinched between the green AVWAP that started 1 and the red AVWAP that started 2. At 5, the stock made a higher high above the red AVWAP from the peak 2, so it made sense to purchase the stock with a protective stop loss below 6, to assure that we take only a small loss if the stock reverses lower. Notice how the stock didn't immediately find the higher momentum. If the stock does not violate the initial stop, in this case at 6, give the stock the opportunity to work. As the stock made a new high 7, we raise the stop to 8, because it is a higher low after the higher high. With each new high, we raise the stop to under each new higher low. In chart 5.2 we raised the stop to the new higher low, 10, when the stock made another new high, 9. When to get involved, the ideal time to buy a stock is as it breaks free of a tight range. The early entry to an emergent trend gives us two advantages. 1. We become involved just as the trend begins, so we have the greatest profit potential. 2. If the breakout cannot hold, we can place our stop close by. For long positions, we place our stops below the most recent and relevant higher low, and for short sales, we place our stops above the most recent lower high. The simple definition of trend tells us there is more opportunity when we buy stocks in uptrends and short the stocks in downtrends. All too often, I see traders fight this common-sense approach and attempt to purchase stocks in downtrends. They are irrationally anchored to a previous price level and view it as a bargain while prices decline. Or they try to short stocks which appear to be up too much, rather than embrace the higher probability and lower stress profits that come from an approach that follows the trend. The tighter the stop we have, the greater share size we can trade while keeping our R multiple a constant. Eventually, one side will take control of the trend. It is most likely that the direction of the AVWAP of the longer time frame will resume its trend because once a trend is established, it is more likely to continue than to reverse. When price comes out of the contraction found in a pinch, it shows whether the buyers or the sellers from the longer time frame AVWAP are in control and whether it is reasonable to expect that a sustainable trend move has begun. The longer time frame participants become emboldened by their profitable positions and are likely to defend the trend. The shorter time frame participants, who bet on the less powerful, shorter-term trend, feel trapped. When feeling trapped, they may exit their losing positions or even flip from short seller to buyer, or buyer to short seller. All of this makes a continuation of the longer time frame trend more likely. In contrast, chart 5.3 shows a pinch with a reversal of the longer-term trend. This stock pinched between red AVWAP that began 1 and the green AVWAP that began 2. As it made a higher high above the red AVWAP 3, it was time to purchase the stock with a stop 4. When the stock makes another higher high, 5, we raise the stop to 6. The stock then made a large surge 7. A strong move like this is often an excellent opportunity to sell part of the stock and then raise the stop on the balance to the higher low 8. In chart 5.3 we see 9 that the shorter-term green AVWAP crosses up through the longer-term red AVWAP, which was from the initial anchor point at the then high 1. Some traders believe an AVWAP cross is useful, but I've noticed no significant trade advantage in them. Chart 5.4 shows us why we do not get involved until the actual break of the pinch occurs. The AVWAP pinch is typically, not always, resolved in the direction of the primary trend. Not all pinches will resolve in the direction of the longer, more powerful trend. The stock in chart 5.4 pinched 3, between the AVWAP's anchor points, green at 1 and red at 2. Because we know a trend once established is more likely to continue with the primary trend, we would have expected an upside move beyond the red AVWAP 2. Instead, the stock broke a lower low 4, and then experienced a large and fast move lower. This type of move shows why it is important to wait for price confirmation to break higher before we buy. If you purchased before the upward momentum was established, you would have seen a large and unnecessary loss. Some traders might think the failure of the upside break was an opportunity for a short sale. Remember, this book is not about counter-trend trades or fading the trend. We are focused on trend-based trades, which is the higher probability of success way to trade. Readers are encouraged to use the information in this book to enhance their favorite trade strategies, whatever they may be. Market psychology. Recognize who has control. You may be familiar with names of patterns such as head and shoulders, triangles, flags, pennants, and cup and handle. These patterns represent a contraction of price range, which then typically leads to a continuation of the price trend. We can also apply the concepts we learned about the AVWAP pinch to those patterns on all time frames. The compression of range simply represents the tug of war between buyers and sellers as they wrestle for control of the trend. The emergence of a new trend out of this compression shows which side has gained control, buyers or sellers, and it becomes their game to lose. We can never fully trust that the buyers or sellers will maintain control once the new trend emerges, which is why risk management is always job number one. If a move does not continue in the anticipated direction, we want to place our stop to ensure that any exit minimizes the risk of a large capital loss. When the stock does move in the expected direction, our job becomes risk management for the open position. Winners do not take care of themselves. Chart 5.5 shows an inverted head and shoulders pattern which is further defined by the AVWAP pinch. If you are familiar with the classic chart pattern, the head and shoulders, Chart 5.5 shows how the AVWPA adds further clarity to an inverted head and shoulders pattern. For simplicity, I've labeled left shoulder, LS, head, H, and right shoulder, RS. Once the stock broke below $54 per share, 2, we knew to set an anchor to the recent high, 1. Then the stock formed the inverted head and shoulders pattern. The AVWAP from the peak 1 then acted as resistance at points 3, where buyers tested the price. As the right shoulder made a higher low, we then anchored a new AVWAP, green, back at the candle at the bottom of the head. At 4, the stock made a higher high. This is where the stock could be bought with a stop just below the most recent and relevant higher low, 5. In charts 5.6 and 5.7, we see an example of a stock in a longer-term uptrend that broke out of the pinch in the opposite direction of the primary trend. It is important to always wait for price confirmation before you put your hard-earned money at risk while the stock is in a pinch. The stock in chart 5. 6 showed 2 important anchor points with large gaps on the day the company reported earnings. At the first earnings report, AVWAP 1 didn't show its significance as support until after the second AVWAP 2 was set. In late December and early January, the first AVWAP, green, showed repeated support, green arrows, for the stock. The AVWAP from the second earnings report, red, showed strong resistance, red arrows, and it resulted in the stock getting pinched. We would monitor this stock for a potential upside break. Chart 5.7 shows that a break in the direction is not assured. Point 3 shows how the price broke lower than the longer upward trend, the first AVWAP in green. Chart 5.7 uses the same stock as chart 5.6. This time, we see the result of trading after a third earnings report, 3, was issued. This was a genuine surprise to the market, as the stock failed miserably after that report. Notice how the stock continued lower for the next month after the earnings report, 4. There are 3 lessons here. 1. Do not purchase a stock while it is in the trendless period of a pinch. 2. New purchases of a stock before earnings releases can be perilous. 3. There is no rush to buy stocks that might appear to be at value after a large sell-off. Market psychology. How committed are buyers and sellers? If prices move quickly and have larger than normal volume levels, it can show us there may be traders and investors from different timeframes competing for the available supply, upside breaks. This behavior is known as a range break. An opportunity to buy after a pullback might not present itself for several days. The speed of a range break can reveal how motivated one side is and may change your entry technique. This can be especially true of stocks that break out when they are accompanied by a fundamental event, such as an earnings report. The stock in chart 5.8 came out of its pinch with a small gap, 7. As always, the concepts and setups discussed occur in all time frames. Chart 5.8 is constructed of 1-minute candles for the first 50 minutes of this day. Anchor 1 occurred at the start of the day after the stock gapped significantly higher from the previous day close. Initially, buyers held control of the stock, but then it broke below the daily VWAP, red 2. A day trader could start a short position with a stop above the high of the day, 3. After the initial bounce, the stock found resistance at the daily VWAP, 4 and 5, and stops could be lowered to just above these short-term peaks. A new AVWAP, green, was anchored to the new lower low 6. The selling sped up 7 as the stock gapped below the AVWAP from 6. Longer-term traders may look at this and not see the value of trading on a 1-minute chart, but shorter-term traders could have the opportunity to profit from more than a 2-point decline in less than an hour. The anchored VWAP pinch is a setup that typically gives us plenty of time to anticipate the trade setup as the stock ping-pongs between the two significant AVWAP levels. You may be tempted to enter the stock before it exits the pinch and makes a higher high, longs, or lower low, shorts, but, as we saw with the preceding examples, an AVWAP pinch is not a reason to buy or short the stock. We should enter the trade when the stock breaks out of the pinch to participate in the emergent momentum. Of course, no trade plan is complete without setting a stop after the entry to protect against catastrophic losses. Risk management trends are not one-dimensional, there are trends within trends, and therefore we wait for price confirmation before getting involved. An AVWAP pinch is most likely to break in the direction of the primary trend. The tighter the pinch, the more likely it is to experience a powerful break. When a stock breaks free of a tight pinch, we can keep close stops and trade more shares with the same R multiple at risk.